Hedge fund billionaire George Soros made more than $1 billion in one day in 1992 by betting against, meaning shorting the British pound. And I'm going to explain why this happened by first quickly explaining how currency volatility works. And what I'm going to do is I'm actually going to use fake US dollars, and I'll also use as a prop and also money from Barbados. Okay, Barbados has a fixed exchange rate. But let's talk about the US dollar first. This is fake. Now, most currencies, like the United States dollar, most currencies go up and down based on the free market and based on how high or low interest rates are. And the US dollar goes up in price if the supply of dollars decreases, okay? And vice versa. If more of this stuff is made, it goes down in price. Okay, and that's how interest rates are changed. Also, the US dollar goes up or down based on global demand for US dollar. So the United States dollar, okay, like most currencies, is actually referred to as a variable currency, meaning it goes up and down based on the demand of the market. By contrast, the currency of Barbados is fixed and not variable. And the value of Barbados currency, the dollar, is fixed and pegged to the value of the US dollar. So if the US dollar goes up 10%, so does the Bajan dollar in Barbados. And why did the Central Bank of Barbados, though, make their currency pegged or fixed to the US dollar? Well, they did it because a massive percent of Barbados revenue, meaning their GDP, is based on tourists from the United States, and currency volatility is bad for business. And so the exchange rate of the Bajan dollar to the US dollar is fixed at a 2-to-1 rate. So what that means is 10 US dollars is equal to 20 Bajan dollars. Now, how does the Central Bank of Barbados ensure, from a supply and demand perspective, that the rate stays at 2-to-1? Well, what they do is they have a massive reserve of US dollars. And the Central Bank of Barbados buys and sells their currency using US dollars to make sure that the rate stays pegged or fixed to the US dollar at a 2-to-1 ratio. Now, could greedy hedge funds short the Bajan dollar and force them to no longer be fixed or pegged to the United States dollar? Yes, they can. But I hope that never happens. All right, let's talk about Black Wednesday, from September of 1992, when George Soros here broke the Bank of England, and he made over $1 billion in one day. So back in 1992, the British pound was pegged or fixed to several different European currencies because England does a lot of business with European countries, and back then the euro didn't exist. And the way to keep the pound fixed at the same level as a basket of other European countries, okay, other European currencies, the way to keep it fixed is the Bank of England has to buy and sell lots of British pounds relative to US or to European currencies in order to keep the value of the pound fixed relative to a basket of other European currencies. Now, the economy in the United Kingdom was just terrible in the early 90s. As were parts of Europe, partially due to the complexity of reuniting East and West Germany. Remember that? And so in August of 1992, George Soros' hedge fund called Quantum borrowed 1.5 billion pounds from many big banks in England. And then he quickly shorted the pound by selling the pound in size and converting it quickly into German Deutschmark. And he thought, hey, if I convert 1.5 billion pounds into German Deutschmarks, then demand for the Deutschmark would rise a lot and the price of the pound would fall big time. And as a result, everybody would be terrified of owning pounds, so many people would sell the pound, and he could then buy back the pound at a lower price and close out the short position and make a fortune. The problem is the pound didn't go down when he did this. Right? So what he did was he more than doubled down, and he said this, let's go for the jugular at the time, not cool. So what he did was he shorted more pounds. And by September of 1992, George Soros increased his short position from 1.5 billion pounds to 10 billion pounds, meaning he borrowed another 8.5 billion pounds. And he immediately sold those pounds, driving the price of the pound even lower. And then what happened was the hedge fund mafia jumped on board, okay, and many other hedge funds actually piled into the short trade by also borrowing billions and billions more in pounds, okay, in short selling. And what happened was the British government, rightly so, freaked out. And the Bank of England, actually, what they did was they tried to buy close to 30 billion pounds at a higher price. But it didn't work because every major foreign exchange trader shorted the pound, and the Bank of England just couldn't stabilize the pound at a higher price. And so the Bank of England, they panicked, and they increased the interest rate that day in September 1992 by 2% in one day. And that's unheard of, to increase it by 2%, meaning 200 basis points in one day. And they thought this would make investors want to own the pound and buy the pound because rates went from 10 to 12% that day. They thought this would push the value of the pound up. But it didn't work at all, as way too many hedge funds were shorting the pound, overpowering the Bank of England's efforts. And so what happened was immediately the Bank of England increased interest rates again that same day from 12% to 15%, okay? And they did this to try to increase the value of the pound relative to other currencies. Now, let's take a step back and think about this. Imagine interest rates in your country going up 5% in a single day. Now, the problem is this didn't work. No matter what the Bank of England did, they couldn't continue to artificially peg, meaning fix, their currency, the pound, to a basket of other European currencies. So what happened was that night, the Bank of England said, we're no longer going to peg or fix our currency, the pound, to a basket of European currencies. And going forward, there would actually be a variable exchange rate policy for the pound, like we have in the United States. So the free market would decide what the pound is worth. And so what happened was the pound dropped 25% very quickly against the US dollar. And it also dropped 15% against the German Deutschmark then. So what happened was George Soros' hedge fund called Quantum, it made close to $7 billion, okay? $7 billion of profit. And the way that hedge funds work is hedge funds get 20% of what they make for investors, which means Soros made more than $1 billion shorting the British pound in that one day. And George Soros later did this to the exact same thing to the Thai baht. And unfortunately, he made a fortune. And I don't recommend shorting stocks, as the losses can be infinite. Instead, if you want to bet against a company, I advise buying puts and using various option strategies, which are part of my upcoming complete options course.